Hey, good afternoon. This is Trader Tim from E-mini Mind, and we're doing a Monday market analysis video. I wanted to start off by looking at the larger time frame, and because we've run up so far off of April of last year, March of last year, you end up with a situation where if you go to a weekly chart, you can kind of draw a line through what was the trend, and then we had the drop from COVID of last year, and then now we're sort of on the other side of that trend line. It's about a 45-degree angle, and now we're above that trend line. So as we project forward, a pullback to something like the 4,200 level uh, would still be in line with continued growth. I mean, even if you go to a monthly chart, you can see just going down to like, um, well, actually, let's go to the SPX. And we'll go to a monthly and we'll back out by another few years here and just kind of like draw a trend line through the general trend, and you say, okay, well, if we were to move sideways or pull back a little bit, coming down to 4,000 or 3,750, you would still be you know well within an uptrend. So I don't think there's major concern for complete market collapse as we start ending some of these stimulus programs that have been in place here in the U.S. Definitely, there's been more stimulus this time around than in 2008, but there's also a lot of cash in the markets right now, and cash buying stocks, cash buying houses. So as we get more down to a smaller time frame and go back to the ES here, I bring that up because as we look at the daily chart now, we sort of are entering this third level of uptrend where we have kind of the 45-degree angle standard trend, then a little bit steeper trend that's rising off of that. Get rid of this guy. And then now going in the last week and a half, we have a steeper trend, and you can see us approaching this 45.36, which is the negative 23% target from our near tag of this uptrend line. And so I am looking at some puts here just to protect my long position in case we do go down. We had a gap up today and go. That's a good sign for kind of getting towards that exhaustive move. It'd be nice if we had, one more day of a gap up and go and sort of just scream past this negative 23% target. The 450, so using just the SPY and using the 452 at the monies are dirt cheap, especially if we look at the calendar here. September, going even just a week out to protect for this week, and then going further out to either the monthly expiration to see what might happen later in towards the end of this week. So we've got the Fed meeting announcement not until the 21st, 22nd is their meeting in September. So it's a little bit later in the month. And then we have expiration the 17th. And then before that, we've got futures rollover. And so there's going to be kind of this couple weeks here of limbo. You're going to have both contracts trading, the September and the December. You're going to have expiration, and then you're going to get the Fed meeting. And then on the 23rd, we should have a little bit clearer direction of maybe some of the time frame on the fall, sort of backing off of some of the bond buying and things like that. But in the meantime, tomorrow, Tuesday, we will be doing a live trading session, and I'm hoping it's a pretty good day because we've got home price index before the bell, and then after the bell, we've got Chicago PMI and consumer confidence, and those can get some catalyst going for the markets. And then Wednesday, employment, Thursday, jobless claims, Friday, employment situation, and ISM Service Index. So there's some good economic numbers coming out this week that might shake things up a little bit. And so I just want to be prepared in case we do get a drop to this trend line further down. If we go to the SPYs, which is what I would use, we're kind of lifting off the top of the channel here. Even if we just make it back down to the channel, like a 447, catching 5 points or so would be nice. If we end up dropping to the bottom of the channel, now you're talking closer to a 20-point drop, and something like that could happen in a very quick time. If you look at the last couple of pullbacks, they're only 3 or 4 days, and then we're bought up at the bottom of the channel. So for as cheap as you can buy puts when the market is up like this and volatility is super duper low, it's super cheap, easy insurance. I wanted to go back to a trade on Thursday because I didn't put together a video. I did a screenshot with some notes, but on Thursday we had that sell-off, and we were back here on the 5-minute chart, just drawing the trading hours only high down to the trading hours only low, gave us a setup on the 5-minute here at the 50%, and then the actual, if you go to the 512 to actually place the order, that was right here on the smaller time frame. So the reason I do that is because a lot of times if you just take a trade on the 5-minute chart, the distance between the 50 and the 61, if you're using the 61.8 as your failure point, or some people now are using a little bit higher than that. I always give myself a couple of ticks as a buffer, but right now volatility is really low, and so the distance between the 50 and the 61 is within our 2-point stop. But when the drawing is larger, or when volatility is higher, that distance between the 50 and the 61 is bigger than our stop. So if you enter on the 5-minute and then your stop goes out at 2 points, your stop is going to be within sort of that failure level. So by using the 512 tick chart, you get a little bit of confirmation or validation that there is resistance on the 5-minute, and then you can come to the 512 and you're going to have an even smaller distance between the 50 and the 61.8. So your 2-point stop is well outside of that 61.8, and then you can just trail your stop on the way down and try and ride it towards the 5-minute, in this case the 5-minute target. But one thing I wanted to highlight on Friday, or this was Thursday, you get these little bounces in here, and notice how the bottom of these candles are the same price level. So I'm leaving my stop above the first candle. So if this is the first one and then this is the second one where they each double bottom, I'm leaving my stop above this candle here. And when we get moving really quickly, I like to just trail each candle as best I can. Sometimes they happen really, really quickly, so you're just kind of dragging it down. But when you get down in this kind of a situation, you have a triple bottom, 1, 2, 3 touches of 44.75. If I would bring my stop down to this little guy here, I'd be taken out versus just leaving it above the first candle up here. And if you go to the just traditional candle chart, this is why I like trailing, using the Hakinashis in the 512, because if you look at this, a traditional candle chart, if you would, if you brought your stop down above the candle here, or even this traditional candle at 726, because we broke the high here, you would end up being taken out. Whereas if you use the Hakinashi to help smooth out, because the Hakinashi is grabbing the midpoint of the prior candle, that will keep your stop just a little bit higher, but it's enough to keep you in the trade and get another rollover, good for another 4 points or so. And then you're just kind of trailing your stop down, and then you can end up getting taken out closer down here towards 44.74, 44.73 area. You can trail swing highs, and that's typically where I'll begin. But when the market really, dives off a cliff, then I don't want my stop to be, 8-10 points away from where price is. So that's when you can get more aggressive and trail each candle. So that was the short on Thursday. Today, I wanted to talk about a little double top that was not a valid setup. And that occurred this morning. Here is the top of the first 30-minute range, this gray line here, 45, 18, 25. And we had this double top, but we did not have a high ticket at that high. And so I did not feel that this short was valid because we were, we're basically, if I go to the daily chart, it's a little easier to see. I mean, you gapped up at highs and you are making new highs. And so when we're in that bullish of a situation, gapping up at highs and making new highs, I want to see a high tick at highs versus just a double top. In other contexts, let's say if I took today's candle and I moved it down here, then the market would not be making new highs. And so looking at this as a short without a high ticket high, I'd be okay. I do like the setup where you have the double top, you break the swing low, and then this 50% kind of lines up with the top of the first 30-minute range. But because of the context of where we're at on the daily chart, I did not like it as a short today. Now, one interesting thing to note, look at, so we're up, we got like an hour left, 50 minutes left here, and we are up 27 points on the S&P, and the breadth and the advanced decline line are negative. Dow is flat, Nasdaq's flat, but the breadth and advanced decline line are basically flat, slightly negative, but a bit of a divergence. And so that's another reason that these gap up and goes at highs can tend to be a bit more of a late to the party folks. This is not your big institutional buy getting in with a huge position. At this point, the big institutions, the folks who bought in March of last year, are using these new highs as an opportunity to take off little chunks of their position and cash in and lock in profits. So really the only way to get into the long today was to do a buy above that double top, buy above highs. When we are gapping up at highs, that's a valid approach to get in. Just do a buy stop, one tick above highs. What you want to see is us in that open space territory. You don't want to do that. You don't want to buy above highs if we're down here, just with a lot of overlapping candles to the left. You only want to do that if you're kind of breaking out into brand new highs with already momentum on the day. So the gap up sort of signaled that momentum. So that's what I've got for you, both kind of intraday and then the bigger picture. I guess one last thing to leave you with is, if you think back to 2008, really, I mean, things got bad. People lost their jobs, and that's what fueled the recession. I mean, all of these recessions are fueled by loss of jobs, unable to pay the bills, and thus, having to foreclose on houses and that sort of thing. So, but it really didn't last that long. I mean, things got better. Even if you bought a house in 2007 or 2008, I mean, values recovered, and so you really don't need to fear a market collapse or be in a position where a pullback is going to cause you to be completely derailed. So I think it's important to keep cash on hand and enough cash to help you sleep better at night. I'm a big fan of when the market and when things are going really good, take some profits, pocket some of that money so that when the market turns around, and eventually it will, and the next time we are in a bit of a recession or some sort of deeper correction, even if it's 5 or 10 years from now, you've got cash at that time to invest with. You don't want to have to be selling one investment when it's down and then buying another investment. It'd be like, selling your house right now to buy another house. Well, you're basically just breaking even because you're sure you're getting more for your house, but you're going to pay a lot more for the house that you're buying. So I don't think it's super advantageous to try and time things in the sense that it'd be pretty high risk to sell your house right now and then um, expect to buy a house cheaper in 6 months. That could happen, but prices could also go up. And if you are planning to put your stuff in storage and live out of a van for 6 months or a year, after a year, things might not turn out the way you want. So what I'm getting at here is you want to have some margin of safety in your entries that you're placing for trades, in the profits that you're taking. If you put on a position of 1,000 contracts, it's okay to take 10, 20, 30, 40, 50 contracts off to or shares to lock in some profits. And then that helps reduce your risk and that helps increase your margin of safety. So that's another reason why when we get into these times where the market is coming up to a negative 23% target, and if you look at where we're at in the trend, you say, okay, well, we're towards, we're not towards the start of this uptrend. If you consider the start of the latest one, the 19th of August, we're closer to the negative 23% target than we are to the 50%. So we have a better percentage of pulling back to the next 50% retracement than we do, even if you look at the minus 618 as the next target. The higher you get, the further away you get from the 50%. So the higher you go, the larger this distance is going to be between the next 50 and the next 61.8. So putting on a little bit of a hedge to protect a short-term down move and then use that money to buy up more shares is a great way to reduce your risk and add and kind of build your long-term position. But otherwise, as far as intraday goes, just trying to replicate day in and day out one strategy on one market and one time frame